Hi, welcome to Sphere Day. What we're going to be looking at is developing an effective Forex trading strategy by understanding the participants in the markets, how they're motivated and how they trade. So I'm going to look at the major groups that trade the markets. Now, most traders who come into the Forex markets do not understand that the Forex market is really just a place to facilitate global trade. A lot of Forex traders think that, everyone is trying to make money speculating in the Forex markets, or the majority. Nothing could be further from the truth. The markets actually facilitate trade across borders. The biggest group operating in the Forex markets is the business group. And by the business group, I mean, from major corporations like McDonald's to Google, who have to do a huge amount of transactions across borders, to medium-sized companies, to smaller companies. They can be basically selling services, buying services, selling goods, buying goods. They create a huge amount of transactions each day. And this basically in the markets is totally unpredictable. It goes on every minute of the day and it never stops. And, it's one of those things, I've said it before, you get a lot of people who will tell you that in 5 minutes or 10 minutes you can predict where a Forex price might go. It's absolutely impossible, because all of these business transactions, you don't know when they're coming in the market, you don't know the amounts, it's just not predictable. So you get what I call a lot of noise, which exists a lot of the time in the Forex markets, where prices just basically ebb and flow with global trade. So the business group is absolutely massive. The next big group would be large financial institutions like hedge funds or banks, and this group is basically generally speculating in the market to make money, although that doesn't necessarily always have to be so. You'll often have financial institutions hedging as well, but let's just say that for the most of the time these institutions are trying to make money. That they basically use technical systems, and they'll basically want to key off major support and resistance levels in the market. And when they come into trade, they tend to come in and trade en masse, and basically they create a lot of volatility around key levels. And when these institutions are coming in, and there's obviously retail traders as well. Retail traders, in my view, are just not significant in Forex price movement whatsoever. They're a minor part. It's these big institutions, and they create a lot of volatility. I've often said that, if you're trading Forex, you're trading off key levels. That's the way to trade. But there's a lot of volatility when you trade off these levels, and you need to use realistic stop losses. So anyone who wants to trade off a major level with a 30 pip stop loss is totally wasting their time, in my view. You've got to understand institutions come in big, they create volatility. You've got to be able to stay with a position and not be taken out by the random noise or the small pullback. So dealing with volatility is one of the major challenges for Forex traders. So obviously you've got this big group of financial institutions that are speculating. Another big group trading the markets, or influencing the market, shall I say, are the central banks. Now, central banks can intervene directly in the Forex markets with intervention, and they're the only group that can really push Forex prices where they want, but they can normally only do it short term. You hear a lot of talk about, major banks can push the markets to a large degree, or brokers can push the market to stops. That's all totally ridiculous. If you look at a central bank, when it comes in to try and push Forex prices, it will normally get the help of other central banks, so that it's got enough money to get the price and move it. And normally central bank intervention is only effective in the short term. Central banks today have another big influence on Forex prices. And that's due to the basically the monetary easing that's been going on from many central banks, i.e. The printing of money. So you've had the Fed have a big quantitative easing program, UK's done it, now you've got Japan doing it. And all the central banks, well, not all of them, but a lot of the central banks are basically increasing their monetary supply, which basically has an influence on the currency's value. In terms of trading Forex markets, it has the impact of dampening down volatility as well. And, I think today, if I was to look back when I first started trading, you used to get much smoother trends than you do now. I think the reason you don't get such smoother trends is basically because everyone has got the internet and instant price action, so everyone is trying to trade together. And also, perhaps 20, 30 years ago, central banks were not so interested in printing money, and I can't remember any doing it when I first started trading. So I think central banks are interfering with the natural economic cycles, trying to influence currency movements by basically printing cash. It's a very interesting book, which I'd recommend anyone read, on the impact of central banks, which is called Currency Wars. It really is a good book. So if you want to trade Forex markets effectively, how should you do it? My own view is, just obviously I've said earlier, ignore any of this short-term trading nonsense in hours and minutes. It doesn't work. You've got to shift your focus longer term. You can be a trend follower, okay? If you look on the charts, you will always see those big trends there. But you have to take into account volatility, which means using realistic stops. So, forget about the idea of using 30 pip stops. You've got to follow those big trends, either 100, 200 pip stops, but you can make thousands sometimes on the other side. So trend following, a lot of people say it doesn't work. It does. You go and look at the long-term charts of some currencies and you'll see, big moves, but there's plenty of retracements and pullbacks which you have to deal with, and short-term volatility. You can also swing trade overbought, oversold. I think this is probably one of the most effective ways for retail traders to come in and trade the markets. You want to wait for currency pair to become very overbought, then basically look to sell it and key off a major level, and vice versa in a bear market. So it's swing trading and you're looking for that reversion back to the mean. I think if you understand the participants of the Forex markets and actually think about how they're operating, you can see how you can make money in Forex trading, and obviously the strategies to avoid. And I think if you actually study the participants, you get an idea that the Forex markets has got nothing really to do with science and prediction. It's all to do with trading the odds and basically understanding volatility. I think a lot of traders don't understand volatility in Forex markets and cannot get their stop losses right because of this. So my own view is an effective Forex trading strategy, long-term trend following or swing trading, and make sure you understand volatility before you come and trade Forex markets. I've done some other videos on it which you can check out. So thank you very much for watching this brief introduction to the Forex markets, and have a good day, and hopefully I'll speak to you soon. Take care.